I think the line by Spider-Man, right? With great power comes great responsibility. I think it's very apt here. So having said that, I think let's move to 2015. We've faced a lot of different issues in 2014. Was definitely, at least in this panel, we can see it was a colorful year for sure. Let's see 2015. The year started with a bang. We have President Barack Obama visiting us, pledging money. A lot of hype. The stock markets are an all-time high. So, Neeraj, what do you see, as we're waiting in the angle of a budget which hopefully will be a big bang budget that everyone expects? What do you see for 2015 in terms of the overall M&A activity?
So, as a banker, I have to be hopeful, right? So, but I think at least this time, hopefully, the hope is justified and not otherwise. As I said earlier, the theme that you saw in 2014 will kind of continue in 2015. I think you will see more investment coming to India, hopefully larger than what we saw in 2014. More deals. You will see more and more private equity deals for sure. I think in sectors like tech, pharma, e-commerce, consumer, TMT, to some example, probably not telecom, but media and technology. I think these kind of sectors, which are high cash flow businesses, you will see inbound and outbound interest, in my view. If you see in 2014, whoever is invested outside India, large part of that is these sectors. Japan theme will continue, in my view. I think money from the West, which is, let's say, European continent and US, that will not be going into real sectors. I don't think will be that quick. Nischal and I were talking about this, before we sat down here. There will always be two views saying that, okay, by budget and by, in 6 months we'll hit there. But I think these companies are actually waiting to see that doing business in India will become actually better. And so if we are able to pass the Land Reforms Act, right, with proper implemented single window clearance, with no EC clearances being hampered on, these are kind of things which will need to be implemented, not just talked about. Will need to be implemented, will need to be tested, and only then you will see real sector investments or traditional sector investment. That, in my view, should at least be a year away. So I think in 2015, you will see the same trend continuing as in 2014. And from what I hear in certain corners is they are now targeting to get a single window clearance by 31st March. I really don't know whether it's possible. And that is like really ambitious. But we've seen how this government reacts to certain things very quickly. I don't know if they can do it, if they can move the bureaucracy. But if that happens, probably by December or next January, we'll start seeing investments coming. If that doesn't happen, probably it's a little further away in my view. So I think in general, I think we'll see better investments. You'll see a lot more investments. Private equity investments will be higher, but real sector investments will take some time.
Thanks, Neeraj, for that. Vaibhav, we talked about how this government reacts and and what it's trying to do to make. I think its sole purpose is to ensure that India is a business-friendly environment. And that seems to be the impetus of the government. What is your assessment of the possible regulatory climate in 2015? You see the regulatory environment easing off. We saw 2015 start off with Tata, Docomo, RBI approval. Do you see, regulators like this have always been firm and stand. What is your view for 2015?
Thank you. I think it is nice for the investment banker to say that the outlook is dependent on how fast government will move on the regulatory side. And if the regulatory side, if the government will move fast, then you will see even bigger and better M&As on a real sector side. Now, which makes me think, where government is likely to move fast.Maybe that will help to see which area you will see more activities. In my view, and the way we have seen how government has done in the last 6 months, the way we have seen the government action as well as in terms of what they are saying, Um, and looking past in the way Prime Minister Modi has done his work in state of Gujarat, there are a few thoughts which come into my mind. First, while we will see a lot of big bang announcements, I think majority of the action you will see is on incremental and small and procedural basis. Here I have 3 or 4 thoughts which I want to share. On procedural side, Modi's target is to make ease of doing business in India to be much more easier. So you would see first and foremost on setting up a company, you would see that a lot of changes may happen where it may be much faster to set up a company rather than waiting for 30 days for setting up a company. So that's the first thing which I feel we will see. Second, what I expect government to do is go a lot more on electronic governance or on e-filing. One of the fastest way to basically move the bureaucracy or overcome the bureaucratic issues is to make on everything online. And knowing how Prime Minister Modi worked when he was the Chief Minister of Gujarat, that is the way he will likely to go. So a lot of changes which you will see will happen on basically automizing the procedural aspect to make it online and make it simpler and easier to find. So that's where I would expect his bulk of his efforts or bulk of his changes to happen. Same way, when you look at regulatory officials, you will find them much more approachable. I already mentioned that last year, in the later half of the year, we did find that Reserve Bank of India being very accommodative for allowing 8-year indemnity escrow. Not something which you would expect it to happen very easily. This is something which we pleasantly found that because Reserve Bank of India said, why not? We can do it. Similarly, Simon just mentioned about the way the Reserve Bank of India is approaching Tata Docomo case. You would expect the officials to be much more approachable and much more helpful in trying to make things easier. I think that also we have already started seeing, and that will continue even more. What at least my expectation is from my interaction with government officials, as well as what I've heard from finance minister and some other minister, is that they are looking at foreign markets and seeing how can doing business in India be very similar to doing business, let's say in US or in Europe or some other places, when it comes to ease of doing business. So for example, Nishith mentioned early on saying that we are seeing a lot more stock swap deals in public market. I would expect that we will see a lot more stock swap deal in private market, private M&A situation, specifically on cross-border situations. So, there will be some movement either on FEMA side or on tax side to make sure that such kind of M&A are not very regulatory difficult, or they're not very tax inefficient. So then that may be a route which the government may take. Again, if you look at earnouts, that is again very normal in international market. And one thing which we have seen is government trying to see if it's done internationally, then why can't we do it here? To make earnouts a lot more regulatory feasible may not be something which is beyond the government's implementation in this year. Similarly, on Companies Act, now one of the biggest issue which we faced in 2014 was the way the new Companies Act was brought in. There were some very nice sites, but some very, very onerous and difficult obligations were put into. To an extent where I know someone knowledgeable mentioned that will share 1% of GDP of India's growth. The Companies Act itself will share 1% GDP. That was an extent of pessimism which existed in the legal market when the new Companies Act was passed. when you dissect and when you see what needs to be changed, you will find that while there are very good provisions when it comes to public company, private company, a lot of flexibility has been taken away. While Nishith mentioned that in 2014 we saw people flip, and he mentioned several reasons. One of the reasons why people didn't like to set up things in India, company in India, is because the flexibility of issuing different options, to get flexibility of getting anti-dilution protection, flexibility of issuing different instruments, all those flexibilities were taken away. We have interacted with bodies like NASSCOM and some of the other associations, and we have also helped such bodies. We know that there is a stringent lobbying going on, and we have very high expectation that there will be relaxation and clarification on New Companies Act, specifically dilution of some of the obligations for private companies. I think that is what we would expect. Similarly, on ESOP, there has been a lot of restrictions which have been put in the New Companies Act. There is a hope that that something also will be kind of diluted. There is an expectation because ESOP is in today's market, especially sitting in Bangalore, we realize that ESOP is a very strong currency for innovating or for encouraging founders to innovate and to raise finance. So that's something which we will see a substantial difference. Lastly, where we are looking at more regulatory changes will be on financial and payment gateway side. We already saw on financial side, let's say on payment banks, small banks already coming in. We have seen a strong focus on financial inclusions, which allows financial to be taken to the rural mass. We will continue to see regulatory changes in this particular space, whether allowing Bitcoins to act as a financial instrument for reducing the transaction cost, or whether allowing technology like Aadhaar to enable let's say there is a company which we are working with which has technology which enables kirana shop or a mom and pop shop to act like a franchise of the bank. So you're going to see more and more regulatory changes which will enable on creating or facilitating payment on online, on the rural areas, reducing the transaction cost so that the economic improvement will happen in terms of payment ability. So I think that's where we are looking at it. Last point I just want to mention is on the labor side. I don't know, many of you may have read as recent as last week, where Maharashtra government has decided to relax its labor norms so that 90% of the companies can fire people, close down the companies without going and getting the government approval. That's the third state after Rajasthan and one more state, right? What we are seeing now is the competition at the state level is increasing in order for attracting industries, and that is where also you will see a lot of regulatory changes. Now, if you really look at it, there are a lot of key regulatory aspects which are in the hands of states, whether it with respect to education, whether with respect to labor, whether with respect to real estate or land, whether with respect to indirect tax, and this competition will, and keeping in mind the way the Modi government goes and the way they influence the BJP-run states, you will see that there will be a strong push on reforms at the state level, which will make some of this process much more easier. So that is where we will see also some changes. Thanks.
Thanks, Shiva. Lots of expectations and lots to look forward to for sure in 2015. And that leads us to what we're all waiting for. I think we're sitting in the anvil of next month we will have a central budget being announced. It's going to be on a Saturday this year. Nischal, we've talked about everything but the mysterious car. Maybe if you can throw some light on GAR, and should people still be worried? What are your thoughts? What are we hearing on GAR especially?
So just before I talk about GAR, I think one of the biggest issues which cross-border M&A transactions are facing in India is the withholding tax issue, especially when a Mauritius entity is selling shares of an Indian company. And this is pretty much the situation in most of the cross-border deals where the seller is a non-resident, mostly structured through Mauritius. The biggest challenge is even though there are favorable case laws from Supreme Court, uh, uh, placing Mauritius as a jurisdiction where you don't have to pay capital gains tax as per the India-Mauritius tax treaty. Because of the aggressiveness of the Indian tax authorities in the last 4 to 5 years, the buyers or the acquirers are not willing to take the risk on the transaction tax, and that's where we see a lot of time being spent in negotiation of the tax indemnities, or we have also seen other modes of addressing the tax issue in the form of tax insurance, which we used in a number of deals. However, right now the insurance companies are falling short of limits as far as tax insurance is concerned. So it's become a bit of a challenge, especially when the seller is a private equity fund, again with a limited life. And in India, as you know, the limitation period for recovering taxes for the seller is 7 years. But from a withholding tax perspective, there are judgments which say that there is no limitation period for chasing the buyer for recovering the withholding tax, and that actually has resulted in a lot of renegotiations on the deal structures, on the deal terms, on the valuations, including escrow of and holdback of certain part of the consideration, or approaching the authority for advance ruling for a private tax ruling on the taxability of the transaction. So there has been a lot of uncertainty on the structuring of the deal when it comes to withholding tax. Having said that, at least the signals we are getting this year from the government is they want to introduce more certainty in the tax regime. We saw the government already taking actions to give comfort to international investors with two of the biggest transfer pricing rulings, Vodafone and Shell, going against the government and in favor of the taxpayer, and the government deciding not to appeal against these rulings, which is something unheard of in India. So that's a great message which the government has sent to international investors. On top of that, the finance minister has also issued guidelines to the tax authorities, 12-point guideline on how to make the tax system simple and predictable. And he has given clear instructions to the tax official that unless you have a very solid case, please don't appeal against the order which has gone against the tax department. GAR, again, we have been talking about this in the last 4 to 5 years. It's always something which the corporates and the deal makers always discuss at the time of structuring of the transaction. It's scheduled to be effective from 1st April 2015, but what we hear from various quarters is that it might get pushed by 1 or 2 years, in the next budget. And that's something that will again send very positive signals to international community if GAR gets pushed by 1 or 2 years. However, the important thing to note here is that the GAR is already applicable even today. All structures which have been set up post August 30, 2010, if those structures earn income post the introduction of the GAR, then they will be subject to GAR. So whether GAR becomes effective from 1st April 2015, 16 or 17, if you are doing a deal today, at least the investment deal, that investment itself is subject to GAR if you are exiting post the introduction of the GAR becoming effective. So we have already seen the structures becoming more and more simple with the introduction, or rather with the GAR being deemed effective from August 2010. And given the regulatory environment and the tax environment we are in, we are seeing more and more preference towards simplified structures as compared to complex structure, which was something which the deal makers wanted 5 years ago. because at the end of the day, when you have a complex structure, you have to explain the structure to the regulators, to the stakeholders, and nobody wants to get into explaining things which people may start smelling something wrong. So I think smell test is another thing which a lot of people are looking at, whether not only optically or legally, whether the structure passes the smell test, and whether tomorrow if the structure is on the first page of Economic Times, will I be able to defend it or not optically? I mean, that's the yardstick which a lot of our clients have started using, and I think that's the right way to go, given the way the regulatory and tax environment is becoming more and more complex. So.
Thanks, Nishith, for that. We've run out of time, but I think it's safe to say that 2014 has been exciting, and 2015 is definitely looking even more promising and quite hopeful. With that, maybe I will throw open to the floor for any questions if they'd like.
We can take questions from
the
audience.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handset while asking a question. Anyone who wishes to ask a question may press star and 1 at this time.
I think maybe if there's anyone from the audience here. Yeah, yes.
My name is Dave. I'm representing Assocham, Apex Chamber. Lately, there have been 2 words which are being circled everywhere, starting from US President to Indian Prime Minister to Davos, everywhere. One is Make in India and other is Digital India. Somehow, some interpretations of Make in India make it look like bringing a technology and exporting the end product in a large value addition or large innovation, which was not possible within the domestic manufacturing domains or capabilities. Second is Digital India, where we need to digitize a lot of information and a lot of so many of the legacy and heritage content. So what is your interpretation of either in the light of this new investment coming, or in the heart of a M&A, where the Make in India can come through an M&A kind of thing, and Digital India can also come in some kind of such, I would say, unique structure.
Mr. Deva, would you want to take this up?
Sure. Let me look at Make in India first, and then we'll look at Digital India. In my view, Make in India will go more from M&A route perspective. But as I think panelists mentioned earlier, they will wait to see regulatory changes happen before the Make in India will actually take off. I think the very first point which I mentioned a little while ago, that if setting up a company takes more than 30 days, you're really not going to get comfort from foreign investor to Make in India. So Make in India would mean that regulatory ease of doing business actually gets implemented before foreign investment comes in. Most likely foreign investment is going to come in form of M&A and also in form of JV or setting up of companies. But to get a head start, M&A will be the most likely way of getting foreign investment. What Make in India means in my view, I think Make in India is all about creating jobs, and any Make in India regulatory changes which the government is likely to make is going to be from that perspective, not just for the money, how much money is going to attract or how much FDI is going to attract, but how many jobs is going to create. So that's where the reforms is most likely to be put into. That's the way I look at Make in India. Secondly, when you talk about Digital India, I think Digital India in my view is already there. Digital India, the way I look at it, the foundation, the building is almost ready. We have just to try to leverage what is existing to go to the next level. In Digital India, what is missing today, really speaking, is innovation in IP and patents. Now, I will just give an example of China. When you think of China, what do you think of it? You will think of as the country where maximum number of IP infringement happens. If you are, if you go a generation back, 40, 50 years back, what you will think of Japan is, Japan was thought as one of the cheap imitators who can manufacture, technology in cheap way. From being a cheap imitator, Japan has come to a very well developed, innovative country. China, from today's perception of being a main IP infringement country, is actually moving towards one of the most companies which have maximum number of patents. And I will just give a simple example. The latest thing in technology is IoT, which is the Internet of Things or Internet of Everything or machine to machine, which is changing the way everything will behave. Just like how Internet changed the way we behave, IoT has a potential to change the way we behave 10 years down the line. Which is a company which has got the highest number of patent application? It is not Cisco, which is evaluating the IoT. It is not IBM, which is the largest patent. It is ZTE. ZTE is a Chinese company which has largest number of patents. When you look at Europe, which is going through bad phase in terms of economy, their company is getting acquired. Who is acquiring? Chinese companies are acquiring. And why they are acquiring? They are acquiring primarily because of their patents and the IP which they have. Now, India has not gone to that phase. If you see innovation in India, really has not picked up. And that is what Modi's government, if you see the BJP manifesto, if you see Digital India focus, the way we believe the government is trying to bring it up is trying to create innovation in India, trying to create IP in India. And I think that is a phase which will happen in future. I don't think it will happen in 2015. I think it's more of a 2016 or 2017 situation where Indian companies will start thinking about IP and start thinking about patent in much larger way than what they're currently thinking. And that is where I think the Digital India will go to the next level.
Good.
I just want to add to this Make in India debate. I mean, there is, as the policy evolves, and we have already started seeing this debate, whether it's going to be Make in India or Make in India, Make for India. I mean, Raghuram Rajan has already alluded to that concept, because it's not just going to be, India is not just going to be an export factory for the world in the next coming 10 years, because you have a large demographic dividend and the global economy is contracting. So to a large extent, it is not just going to be Make in India, but it is going to be Make for India. So even the investment in real economy, companies who are coming in pursuant to a merger or acquisition, eventually you will see a lot more investment in infrastructure, because these companies will slowly realize that if you have to make in India, make for India, you need to have a robust infrastructure. So that's why I think there will be a lot more investment in infrastructure if Make in India itself has to succeed, both for India and foreign partners.
Defense is an example. They're trying that in defense. Make for India.
Correct.
Yes.
Either Vaibhav or Nishith, regarding the earnouts, e-commerce seems like a dicey thing to me. There would be a lot of difference between the objectives of seller and the buyer, and how the earnouts are calculated, and whether it adheres to the business plan. So a lot of equity is coming into e-commerce, where the revenue streams are not yet established in India. It's just evolving. How do you think it is going to, especially in the earnout side, different dichotomy between the seller and the buyer way of working it out?
I think first of all, I won't talk about the valuation in e-commerce, because I think nobody understands that. In a loss-making company, how come the valuation is in billions of dollars? So maybe Neeraj can throw some light on it. He must have valued few companies. But I think earnout, again, it depends on to which milestone you link, right? In a normal company, you link it to EBITDA. In an e-commerce company, I think the top line is very critical. So as long as you are able to agree with, agree on the milestones between the buyer and the seller, and for what purpose are you giving the valuation, then I think the earnouts could be structured in an e-commerce type of situation also. So it really depends on what is the parameter based on which you are, valuing the earnout in future. Maybe Vaibhav, you want to add anything?
That's the usage is growing. So do you see
Right.
more disputes coming out of earnouts in future?
See, I think it's sector agnostic. I think the disputes happen because of the way I look at it, happen more because of individuals rather than the sectors. Somebody with a good intent, and I think both Neeraj and I had worked on a deal together where we had a fantastic promoter who, in spite of being a private company, had half of his board as independent directors, and the independent directors, both of us had to fly down to Calcutta and Delhi on a Sunday to explain the structure to them in a private company. So, well, and on top of that, even the valuation mismatch and all these things were compensated by the promoter to the private equity investors. In spite of the fact that there was a way out for the promoter to say that Indian regulation don't permit. So it clearly depends on the intent. If you have good intent, then any problem can be resolved. If the intent is not good, then there is always a loophole, and lawyers are always available to identify the loophole under law. So that's my take. I think it's very individual specific rather than sector specific.
Let me add a couple of points here. One, if you really see, earnouts have been used mainly in services company rather than on e-commerce or on product companies, primarily because of the issue which you mentioned. Now, when you look at earnouts, it's typically on an M&A transaction, where the party is actually exiting, the company which is acquired is exiting. But if you also put an earnout kind of situation, not really earnout, but earnout in private equity investment situation, that also we have seen it happening in recent past. And I will just tell you how in both situations we have seen it happening. First, on an e-commerce basis, when you're looking at an M&A, really speaking, you will not see earnout in terms of cash payment, but you will see it in terms of stock options. Your earnout really is given based on stock option. Basically, you give the company which is acquired will give stock options, and your stock options will be measured with certain revenue parameter, which the way the company will behave. And that is where I think the earnout has been given. And we have done several e-commerce deals, including for Flipkart. In all the deals that we have seen, stock options have been critical to determine how the person who was acquired, or the promoter who was acquired, is compensated for the role going future post-acquisition. Secondly, when you look at the private equity situation where private equity does investment and they want to give earnout to the promoter or a founder, especially in e-commerce situation, as you rightly said, there is no way you can determine how the revenue or how the profit is going to be determined, because there is no revenue, there is no profit, even though there is a revenue at some point in time. Where we have seen is in that situation is the earnout is based completely on the valuation. If the private equity gets X IRR return, this is the earnout which private equity will give to that particular promoter. If they get Y IRR return, then there is some other numbers which have been placed. So the earnouts have varied based on the objective, and as Nishith rightly mentioned, depending on the objective, you will identify which parameter you want to measure for giving the earnout.
How does the earnout get embedded in terms of in sync with the pricing guidelines?
So the way,
Okay.
so depending, I think you're asking about if there is a non-resident acquirer.
Yeah, cross-border.
So first is under the Indian exchange control regulations, deferred consideration is something which requires prior RBI approval. So you cannot structure a transaction where you are transferring 100% of shares on day one, paying 70% of consideration, and the balance 30% consideration you link it to the EBITDA or any other performance parameter of the target company. The way earnouts are typically structured is instead of selling 100% on day one, you leave certain shareholding. And let's say 91%, because 10% gives substantial rights to an Indian shareholder, the minority protection right under the Indian corporate law. So you don't want the seller to own 10%. So something less than 10%, let's say 91%, you transfer for 70% consideration, and the rest of the 9% you link it to the 30%. Now the interesting part here is that the 9% when you are buying at a higher valuation, that's something which RBI allows, because when you are investing there is a floor. As long as you are above the floor, that's fine, and it's never going to go below the floor in most of the situation, because that's how you even determine whether it should be 91% or 99%. And that's how the deals have been structured. And from a promoter perspective, also, or the seller's perspective, it works because he doesn't have to pay capital gains on substantial amount on day one, which if it is structured as 100% transfer of shares versus 70% today and 30% later, under the Indian tax laws, the trigger event is the date on which you transfer the shares. So, you don't want to pay tax on the 30% which you have not even received and which is contingent upon happening of a certain event in future. So that way also tranching it out in a manner where 91.9 or whatever, any combination in between, that works well both for the acquirer and both for the lender.
Just to add to what Nishith said, this is something which is what happened in 2014 or till 2014. In 2015, we just hope that it's a simple RBI approval or automatic approval in which you can do it. But having said it, we did a transaction this year in later half of 2014 where we got RBI approval for deferred consideration and paying an earn-out. And RBI looked at it very positively and gave the permission for deferred consideration without any major issue. So I think that's a positive situation we have seen. I think more and more situation you will see RBI giving approval for deferred consideration as long as the base price which is paid meets the pricing guidelines, right? So that is one positive development which has happened from FEMA perspective. The bigger issue always has been the tax side. As Nishith mentioned, if you're looking at an earn-out situation, the big stumbler is irrespective of whether you get your earn-out or not, or when you get your earn-out, generally you end up generally is considered to be accrued on the day the transaction happened. So for example, if your earn-out is, let's say, 30 rupees and your fixed payment is 70 rupees, which means your earn-out can vary from 0 to 30 and your fixed is 70, you will have to accrue full 100 rupees as your income when you get your 70. That has been the biggest stumbling block. What we found out that if you structure your earn-out within period of 1 year, and if the way timing works out fine for you in that particular case, then even though 100 rupees are accrued for you, tomorrow if it happens that in a period of 1 year time when the earn-out can happen, if you've only got 80, you can revise your income and basically change your income from 100 to 80 and not really end up paying additional tax for the earn-out. So an earn-out for a period of 1 year is something which you can do without resorting to any major structuring, by simply going to RBI, getting an approval and using the benefit which is there on tax side to do a simple earn-out structure.
But there are also other ways of structuring an earn-out. It depends on the type of transaction. For instance, we're doing a 51%, and it's a valuation issue in terms of what value the promoter is supposed to get to the table, or what value the promoter is supposed to hold back. Use of optionally convertible instruments can also sort of work that out, which function seemingly like an earn-out. So there are other ways of also structuring earn-outs.
So, if I can just add, if you look at let's assume we are only talking about M&A and not private equity, because in private equity, in my view, there is, given that you are at a minority shareholding, there is some more leeway to structure things. Let's assume we are talking either about a 51% or 100%. And we've seen earnouts across sectors. I think it's becoming more and more prevalent. It gets talked about more in the tech and e-commerce sector, but I've done it even in the real sector and manufacturing and all. It works the same way. In my view, there is no difference. If it is 100% sale, without doubt, in my view, it will lead to a debate, if not a dispute. And we have, in one situation, we've also advised in a dispute, in arbitration. So the buyer had appointed us as their bankers in arbitration, and the sellers had appointed another banker in arbitration to give a view on certain parameters in the market, etc., and to give our view. So without doubt, sir, in my view, if it's 100% sellout because you've sold the company, you're gone, the buyer is in control of the company, there will always be a debate that you didn't run the company correctly. So invariably, it leads to a debate. Whether dispute or not is the second question. If it's a 51% structure, then conceptually, Indian exchange control regulations don't have a problem if you pay any kind of amount to the resident. At least that's my view, under a contract. Okay, so you can have a part sale, you can do the sale later, or even if it is sold 100%, I can make a further payment to a resident without cost under the same contract. Like, I'm just making an earn-out additional. So if it is to the resident, there is no problem. So typically what we've seen people do is to flip the structure. You say, okay, I will not start with 51, but I will start with 74. And I will keep 24% in escrow, and that effectively, so instead of starting low and you creeping up, you start high, the non-resident starts high and comes down. Okay. So that conceptually, that structure, in my view at least, works under Indian exchange control regulations. Now, commercially, whether it works or not is always a debate, because the guy who's controlling 51 plus is always in control of the company and has higher power, higher influence. Escrow is enforceable, not enforceable. What kind of debate it leads to? That is always the commercial question. But this kind of a structure in a non-100% scenario works, I think, better. The same way if you flip it even for 100%, that, whatever has to be done in favor of the resident rather than in favor of the non-resident. Okay, right? If you flip it that way, I think there are structures where you can make the earnouts enforceable from a legal perspective. I don't know, Nishith, is that fair?
No, I think it's each deal has its own specifics. For 100% you have to think differently. For 51% you have to think differently. 75. So as long as it is within the four corners of law, all structures are enforceable and possible, and four corners of commercials also. So I think each deal, we have, as Simon mentioned, you can also use convertible instruments, you can do 91-9 structure, you can do 75 structure coming down to 51. As long as you're meeting with the pricing guidelines and you're not breaching on any of the put options with a short return type of thing, I think it's absolutely fine.
Yeah.
I understand two related questions. I understand a lot of proposals for investment are stuck with those which are originating from Mauritius. Almost 30 such proposals are stuck at FITB level for the past several months. I don't know if you have.
Not to my knowledge. All proposals come from Mauritius only. So first of all, majority of the cases, come from. I think it will be more sector specific rather than to deal with Mauritius. Like for example, proposals for pharma sector, right? The government wants to look at it in more detail. What's the technology with the foreign partners bringing in? Do they have a non-compete covenant if they want to examine closely? So more than the country from where the applications are being made, it's more to do with the sectors in which the foreign investment is coming in. On top of that, one of the things which FIPP has started doing since 2012 is to ask for details of the ultimate beneficiaries of the fund. Now, that's a very tricky thing, especially if you are a private equity investor and not a strategic investor. To give details of the beneficiaries, who are your LPs or investors, is a very difficult task because the documents with the LPs or the investors are signed with the fund, they have confidentiality clauses. And if LPs are subject to the risk that they have to disclose or their details will be disclosed to Indian regulator, they will never invest in your second fund. So there are a lot of challenges. In fact, we ourselves have handled multiple applications where, in some of the cases, FIPB has been happy just with the statement that, the LPs are sovereign wealth funds and pension funds. So once you give that statement, there is a lot of comfort which FIPB has that, these are all institutional investors with sophistication of investing in a fund. As compared to that, the moment you say that LPs are high net worth individuals, NRIs, where there is more the chances of money laundering or round tripping or these type of things are more as compared to when an institutional investor is investing in your fund. In those type of situations, they want to go into more detail. Or what is the source of funding of some of these LPs? From where are they coming from? No Indian money has been used to root it outside India and again bring it back into India. So these are the things which from a money laundering perspective, FIPB is worried about. And if you are able to give comfort to the investor, to FIPB on this issue, then FIPB clears. Otherwise, other than that, we haven't seen too much of a concern from FIPB.
Investors from Mauritius have a different maybe line of questioning more than anyone else, from the department. But I think sectors like pharma were held up for a very long time, and then there was a spate of approvals that came in through after the government. In fact, there's been a diktat by the government to the FIPB to clear proposals within 3 months. So that has been the diktat of the government, and we've seen that happening in the recent past.
Even if you see the last FIPB agenda,
Yeah.
several Mauritius proposals have been different. This is a fact. Sure, Mauritius proposals are on. I was only wondering, a lot of them, well-known proposals or strategic investments are going through. I was wondering if you have any insights on when it is going to.
In fact, if you see the list of proposals cleared also, a lot of proposals are from Mauritius entities. So the reason for that is because overall the maximum number of proposals which come to FIPB come from Mauritius. So it's not only majority in the approvals given, but it also from majority in the approvals deferred or rejected. And in one of our clients' case only, the client was not comfortable giving details of LP. They said it's fine, let the approval be rejected. We are fine with it. We'll figure out some other structure to invest, but we can't risk the names of our LP and details of our LP going to FIPB, then to CBDT, and then queries being raised on the structure. And we don't want to get into all this. India is a small portion of our global fund, and we don't want to take that risk of investing in India through the FIPB.
So I think with that we will
Last about the proxy advisory and the shareholder activism, that's clearly on the rise due to the more probably foreign institutional investments coming in. So do you see they're backed by any agenda or what? I mean, it seems like UK style mining, Coal India case, Vedant also.
I don't think it's backed by any agenda. I think this is something that any developing economy will see such kind of activism. I don't want to attribute motives to anyone. I'm not aware of one. So I think it's just part of the process. That's how I think most, if you see the developed economies also, that's how the corporate culture has evolved. If you look at Japan, which was also a very family-owned, controlled shareholder economy, the way it's evolved, you see more and more shareholding. The more dispersed the shareholding is, the more investors become conscious. And, if one were to take a position, there is a view that in fact shareholder activism does help, where the management is in fact not functioning. It's not like all managements are doing the best to the best of their ability. So to that extent, I don't see any ulterior motives. You can attribute ulterior motives to certain hedge funds, etc., who have more short-term view of things. But I'm not aware of a situation where there is in fact an ulterior motive apart from sort of creating value for themselves.
In fact, we have actually represented a couple of hedge funds in asking some of the tough questions to. So in the wholesale Ambuja deal only, we were representing one of the hedge funds, which was holding about 2% in Ambuja, questioning the structure and why the entire I think about 3,500 crore was directly going to wholesale and not distributed among the public shareholder. So they were genuinely concerned. It's not that they wanted to get something out of it, because ultimately the public shareholders were not getting equitable treatment as the promoter of the company, which is something which SEBI always keeps on saying, that all shareholders in a public company are equal. It's something which comes out of genuine concern. We actually wrote a letter to the board, and board actually had some discussions with our client to convince them that whatever they are doing is within the four corners of corporate governance. Our client got comfortable. They were not aware about some of the facts which the board convinced them about, and finally they were okay with whatever happened. The structure was implemented. So
But your question is not unfounded. We've had this question a number of times.
From natural
Where-
resources sector.
Where revenues of proxy firms are questioned, where interests, motives of revenue firms are questioned. So there have been some talks on that.
In light of the recent Greenpeace incident, I mean, it was a small incident though, but with local activists lobbying the parliaments in UK, etc. I mean, and if you see the Coal India, the proxy advisory firm that was raising objection, is known to create issues in the mining sector throughout the world. So I just, whether it is linked, I was talking about that. I was not talking about the hedge fund side. I was talking more from the natural resources perspective. Vedant and Coal India were the examples I was using actually.
So maybe we can have this discussion offline. I think we're running out of
yeah, I
time.
mean, again, as I mentioned, it's again individual.
So with that, I think let's wrap up this discussion. Thank you for being a wonderful audience.
Thank you.
Thank you so much.